Have you ever wondered if you could use the equity in your current home to buy another property? In this video, I'm going to give you a step-by-step guide about the types of loans that you could use, when you would want to use them, so you can look towards buying whether it's a primary residence, maybe an investment property, or even a second home. So check it out while we talk about home equity, what it is, and how to use it. My name is Sam Sharp. I've been a mortgage lender for over 22 years. I've helped over 10,000 people buy a home. My goal with this channel is to provide information to help you when you're looking at buying, selling, investing in real estate, just approaching your financial goals in general so that you can make a more informed position whenever you're looking to make a move. Let's get into it. What is home equity? Home equity is basically the amount of money or value that you have in your home. And this is based off of if you don't have a mortgage and your home was to appraise at, which is generally going to be the market value someone's willing to pay for your property. So if your home appraised for $425,000 and you have no loans, then your home equity is basically $425,000. Like most people, we have mortgages on our properties. So when you want to determine how much home equity you have, you'll basically take the amount of your loan minus what that home's estimated value is, right? So in this scenario, if you had a $200,000 home loan and your home's estimated value was $425,000, then you would have, well, 425 minus $200,000, so you have $225,000 in home equity. So how do you actually build your home equity over time? Well, there's several different focus points here. One of them you have no control over, and that's going to be market appreciation. Market appreciation is basically the value of your home's increase. By owning that property and the ownership of that property, well, your property will increase over time. On average, in most markets right now, we've been seeing roughly about 3.9 to 4% appreciation. So you're building equity. If you had a $100,000 home and it was appreciating just based off that market rate of say 4%, well, now you're in a position where your home equity increased to $104,000. Keep in mind, home equity is the difference between what you owe on your mortgage and the estimated value of that property. So this is what we call equity through amortization. And equity through amortization is when you make the monthly payments on your loan, you're paying down that balance. The less you owe on that loan, the more equity you have. At the same time, you have the appreciation on that property that's increasing. Remember, if we're using that 4% per year, depending on the markets, well, now your property is going up in value while your loan goes down. So you're building equity by paying down the loan while also watching that market improve around you. One of my favorite ways to build home equity, because you can actually do this with your own actions, is home improvements, right? Improving the place where you live. And unfortunately, a lot of people wait until they're going to sell their home to make these improvements. And now they put in that nice kitchen or the bathroom, which is pretty funny when someone, like I've had clients who will make these improvements and then all of a sudden they don't want to sell their home. I mean, they've made television shows about this. But keep in mind, when you make those home improvements, again, you're increasing that home's value. You're now widening that gap between what you owe on that loan as well as what the value is of that property. So it's great. You improve your space, you improve your quality of life. You're also now increasing that home equity. All right, so now we understand what home equity is. Now let's talk about how can you tap into that equity? How do you actually get that money out of your home and into your pocket? For this video, let's cover 4 different ways that you can access that home equity and to get that money out of your home. The 4 ways that you can tap into that equity is going to be a home equity loan, a home equity line of credit, a cash out refinance, and then of course, selling your home. So a home equity loan is a second loan in most cases, because assuming you have a first mortgage in place, you'll be taking out another loan. So we call this a second mortgage. But a home equity loan is a fixed product. So this means you're taking out a loan that's fixed at a set interest rate for a certain amount of time. This can be popular. Most people don't like the idea of their interest rate moving up and down, so they'll look towards this option first when they're considering a second mortgage. Spoiler alert though, because of that stability, if you will, these loans tend to have higher interest rates than some of the other options. So for example, let's say you have a home that's worth $425,000, you owe $200,000. Well, a home equity loan, they have limits. You can access anywhere from up to say 80, 90, 95% of that home's value. So to make this even easier, let's say we have a $400,000 home and we want to access 75% of that value. Well, basically that means you can get out $300,000 out of the $400,000 value, right? So you're going to have $300,000 worth of equity in that home. Well, if you owe $200,000 on your first mortgage, the home's worth $400,000, and you can take out $300,000. we then subtract the $200,000 loan from the $300,000 limit, which means you can now take out $100,000 on this fixed rate mortgage. You then have two mortgage payments. You have your payment that you were paying on that $200,000 loan originally, and now you have a new loan or second mortgage for that $100,000. All right, so next, let's talk about the home equity line of credit, or HELOC. So a HELOC is very similar to a home equity loan in the fact that you're taking out a secondary mortgage in most cases. So you're taking out a second loan. The primary difference between the two is that a home equity line of credit is going to be a variable interest rate. So this payment will go up and down. Whenever you hear about the dreaded Feds meeting, the Feds are meeting, interest rates are moving up and down, keep in mind that a home equity line of credit will follow that every time. So if the Feds decrease interest rates 0.5%, that goes down 0.5%. But on the flip side, if they increase interest rates, your home equity line of credit will go up that same amount. Whereas that home equity loan stays fixed. So this loan's not going to be fixed for a certain amount of time. Also consider that a home equity line of credit is an interest-only payment. It's kind of like a credit card on your home. You're taking out a loan, that interest rate can be a variable up and down, and then your monthly payment requirement will only be interest only. Some people will look at this as a plus or a negative. I'll frame it for you two different ways. One, I like the fact that you can minimize the amount you need to put towards that payment, because now you can actually pay this based on your own comfort level, your own schedule. Especially if you're going through and you're doing a home remodel and you're taking this equity out, just keep in mind you may actually need to pay less during that time frame because you have other expenses. So the home equity line of credit is great because you have control over that. Now, on the other side of this, keep in mind that you are in control of paying that loan down. If you just make that minimum payment like a credit card, well, that's just going to keep revolving and revolving, and you're not going to pay that balance down. So there's some pros and cons to both sides, but I think one thing that we should talk about is that a home equity line of credit can generally have a lower interest rate than a home equity loan. And that's because of that instability, because that interest rate can move up and down. Well, that tends to offer better terms. So something to consider. Here's one of the things that I think is the biggest difference between a home equity line of credit and a home equity loan. So keep in mind, when you take out a home equity loan, you're taking a loan out for a set amount. So in that example we use, that's $100,000. This means that you're borrowing $100,000 and you have a monthly payment to repay that loan, and you have to pay back the entire amount, regardless of whether you need the money now or not. So now going with the example of improving your home and making some repairs, on a home equity line of credit, you only have to pay interest on how much you borrow. So you can take out a $100,000 home equity line of credit, but let's say you only borrow $10,000 for a set period of time, well, you're only paying interest on that $10,000. So you only pay on what you've actually used rather than how much you've opened that line for. And this is great because it can minimize how much you're paying while still allowing access for the remainder of the funds. All right, real quick, if you're getting value from this video so far, I want to let you know about a newsletter that we send out. Don't worry, I'm not going to spam you, but if you sign up, there's some great information similar to what we're covering in this video, as well as some other real estate tips. So we'll give you a lot of information that's actually going to be useful and help you have a better understanding of the next move that you want to make. Click the link in the description below to sign up for this newsletter. But for now, let's get back to the video. All right, so next in line, let's talk about a cash out refinance. So a cash out refinance is going to be keeping everything under one loan. So you have let's say a first mortgage in place for $200,000. You have that home that's worth $400,000. Well, in this position, you're going to take out a new loan, paying off your first mortgage. So you're going to pay off that $200,000 loan, and then you're going to add to that the additional cash that you're taking out of the home. So you'll now end up with the first mortgage. So this is the only one loan in the first lien position that will be for the entire amount. Some of the benefits of a cash out refinance can be a lower interest rate than, say, a home equity line of credit or a home equity loan. In these cases, you might have a better interest rate. Also, some people like to have that one-stop shop, if you will, right? They just want everything under the umbrella of one loan amount and that fixed payment. So you can get a better interest rate on a fixed loan over a set period of time for just one loan. So one thing I think that's really important, just to clarify, in most cases, this is restarting your loan, right? So if you've been paying on that loan for 5 years and you take out another 30-year loan, then yes, you have a new 30-year fixed mortgage. But something to keep in mind, you don't have to. When you're opening up a loan, taking out a cash refinance, talk to your lender about using a set period of time. So in this example, you have 25 years left on your loan. Fun fact, you can actually take out a 25-year fixed loan. You can take out a 26, 27, 28-year loan. You don't have to use a 30-year product. So when you're using a cash out refinance, keep in mind you don't necessarily have to restart the clock. Now, something to keep in mind, at the time of recording this video, mortgages are around 6.5% and higher in some cases. So a lot of people don't want to look towards a cash out refinance because they don't want to lose that low interest rate. Maybe they have a rate in the 3% range. However, you want to look at this from multiple angles. If someone has, let's say, a $200,000 loan on their home that's at 3%, well, that's great. But what if you have $100,000 in credit card debt that's at 27%? So you want to keep in mind there actually may be a benefit by using a cash out refinance to pay everything out. Your overall cost could be better. So when you're talking to your lender, make sure you explore these options. Look to say, okay, how do I reposition what I owe? It's not necessarily just because you owe a certain amount on your mortgage or the cash you're taking out, but it could be some of those other accounts and bills that you have open. All right, so last, selling your home. I know that sounds straightforward, right? Keep in mind, you sell your home, you owe $200,000, you sell it for $400,000, and you have that $200,000 gap for the equity, and that's how you get the equity out of your home. But keep in mind, when you do sell your home, there are closing costs. So you want to keep in mind, maybe you don't owe anything on your mortgage. You still have closing costs. You're going to pay title charges. You're going to pay other fees that go into agents' commissions and other costs that will offset that line. So you want to get what's called a net sheet. If you're using a real estate professional, which I highly recommend you do, you're working with your agent, you want to ask them or your attorney if they're involved to provide a net sheet, because that'll tell you basically how much are you walking away with. All right, now a quick bonus on these options is what we call a bridge loan. A lot of times homeowners want to take the equity out of their home because they're going to use this to buy another property, not necessarily an investment. Maybe they're buying their next home. So a bridge loan is a great way to access that equity without selling your home first or using any of these other products. A bridge loan allows you to purchase a new home while using the money that you would have in equity. So it's based off the equity you have in your current property. So this will allow you to basically take out one loan on that property while maintaining your current loan. The reason why this is beneficial is that maybe you're in a position where you're buying a new home, you have your current loan in place, you need the equity, you can't get it, and maybe you can't buy that new property otherwise without selling your home first. A bridge loan is a great way to get around that home sale contingency. Spoiler alert, I will tell you though, bridge loans can be very expensive, so you want to make sure it's the right situation when you use this type of loan. Otherwise, you may benefit more from using one of the other products. So now that we understand how to get the equity out of your home or how to get access to that money, here are some of the ways that I recommend that you would use that equity or that money. First, all right, so let's talk about buying a new principal residence. If you're gonna look to buy a new home, perhaps you need the money from your current home to put towards the down payment on the new property. So that would be one of the, I think, more obvious examples. Next in line, what a lot of people will look at is using that equity to purchase an investment property. This can be a great way to get a down payment for another property and leveraging your cash. So you're using that equity to go through and expand how much you owe or how much you own in real estate. It's a great option. Next in line, paying off debt. You know, as I mentioned earlier, you may be in a position where, yeah, you have a low interest rate on your mortgage, but if you have a lot of debt on credit cards or other accounts that are at much higher interest rates, well, there could be a great option using your home equity to save you some money. So keep in mind, at the time of this recording, credit card interest rates are over 30% on average. We have a higher debt on credit cards than we've ever seen. So more Americans have credit card debt than ever. So if you're in a position where you have 30% interest rates, you may have 3% interest on your home, but a 7% interest rate on that total debt could save you hundreds of thousands of dollars. And one of the last things to consider is having an emergency fund. It's not uncommon to use a line of credit or a home equity loan or one of these options so that you can set up a fund. I have a client recently, he's in the tech industry, he's very worried about his job. You know, he was saying, I think there's a good chance I might not have a job soon. He had a great interest rate, but he still chose to go through and use a cash out refinance so that he could get the money at the cheapest terms while keeping that money in the bank. Just a quick tip, if you take that money out and you have that equity, try to place it somewhere safe that can earn you some money while it sits. All right, so we've covered a lot of great ways that you can access the equity in your home and take advantage of that position. But at the same time, we've got to look at both sides of the coin, right? I guess just because you can doesn't mean you should. And if you do, then what are some of the things you need to consider about how this could impact you in the future, right? So when we're going through and looking at this, I think one of the things a lot of people need to realize is that when you take that equity out of your home, you're closing that gap between what your home value is and how much you owe. So now if you're in a position where your market starts to drop, let's say that home value starts to come down, well, now you might find yourself in a negative equity position, or you might find yourself in a position where you don't have access to these funds should you need them in the future. So make sure you're taking the money when you need it, not just because. Another thing to consider that could be on the other side of this is overall, when you're looking at taking out loans, lenders will consider how much you owe. What are your monthly payments? When you take out a home equity line of credit or a home equity loan, cash out refinance, you're increasing those monthly payments, which then could create issues when you borrow in the future. For example, I did mention perhaps you want to use a home equity line of credit to get the equity out of your home to buy a new property. Well, keep in mind when your lender's looking at your options, they now have to consider that monthly payment against your qualifying ratios. So that could create a position where it's more difficult to qualify for more loans. And I think one of the more obvious things to consider, you're taking on more debt, right? You're in a position where now you are using this vehicle, your equity in your home and that value in that money, but you are taking on more debt. So I think it's best to consider why you want that money, what you're going to do with that money, and then also just make sure you're thinking about what that looks like in the future should you ever need that money again and it's not available. All right, so we now understand what is equity, how do we get the equity, and what can we do with it, right? But let's talk about the reason why you clicked on this video in the first place. Let's talk about how to use that equity and why you would want to use that equity to buy a new home. All right, so here's an example of how this would work and how I would suggest you actually use that equity to benefit you in the future when you buy that next property. So say you're in a position where you need that equity, right? You want to put a larger down payment because you don't want to have a high monthly payment on your mortgage. Keep in mind when you're buying that next property, maybe you have 5-10% to put down, but now that end mortgage payment is higher than what you want, or you have PMI, right? So you might be in a position, I have clients who want to go through and they say, okay, I just want to make sure that I have a lower monthly payment to start because you may be carrying both mortgages for a set period of time, right? So you want to pay as little as possible. Well, this can be a great way to access the equity in your home to put a larger down payment down on your new property. So now you have that lower monthly payment by using a home equity line of credit on your current residence. Keep in mind that's an interest-only payment. So now that means your monthly expenses are going to be lower while you're transitioning, while you look to sell that property, right? Maybe use that line of credit to make some improvements, to sell your property for a higher price, and you also access the money you need to have a larger down payment on your property. This way, when you sell your home and it pays off your mortgage, pays off that home equity line of credit, keep in mind, you sell your home, it pays off those loans for you. Well, now you're in a place where the end result is a final mortgage payment that you're much more comfortable with. All right, so let's go back to our example, right? You have that $400,000 home, you owe $200,000. Well, maybe you're moving into a larger property. Now you're gonna buy a $600,000 home, okay? But you only have maybe 10% to put down on that home, so you only have $60,000. Well, keep in mind in the earlier example, you have a lot of equity in your property. So $200,000 loan, it's worth $400,000. That means you can easily access another $100,000 out of that. Maybe you take the line of credit, you take out $100,000, you make some home improvements to improve the value. Maybe you don't. Maybe you just take out the $60,000 you need. So that $60,000 in home equity plus the $60,000 you have just puts you into a position where now you can put down 20% on your new home. Why would you put 20% down? Well, now you have no PMI. You have a lower monthly payment. You're also in a position where you don't have to worry about refinancing or recasting the loan in the future after you sell your current property. So overall, this could put you in a much better position financially. All right, so I know that's a lot, and that's just a general overview of this process. And there are a lot of moving pieces. I think that it's important, make sure that you're coming up with a strategy that works best for you because it's not one size that fits all. So you need to talk to a qualified mortgage professional, find out what your options are. One thing I always talk to my clients about, remember, it's more than a mortgage. You're in a position where there's so many moving pieces and you need to place yourself in the best possible position financially. Setting up a strategy and planning ahead for that can put you in such a better position than looking later down the road and realizing maybe you should have went a different way. If this is you, sounds like you, someone you know, then please reach out. There's a link below that you can click so that we can connect. We can talk about your strategies, the best way to move forward. So this way you can make sure you're in the best possible position. And of course, I'll see you in the next video.